time that AC/DC play the Melbourne Cricket Ground.
Ever?
They had a show. They had a show a couple of nights ago. Half of Melbourne could hear it. Absolutely awesome. Because you went to go and see them in LA the other day.
I saw them at the Rose Bowl in April, and they're playing in Madison, Wisconsin, my hometown, in July. I already got tickets for next July, so they have one last little run in them. I mean, Brian is not his former self. Like, he's out there, which is nice, but he can't really hit the notes that he could. And but Angus was as good as ever. He did like a nice 20-minute, solo, 7 minutes with just his left hand. Yeah, it was quite good.
What a fucking legend. What a legend. Hey, we got the red hats on today, Benny.
Red hats. It's a good red hat day.
It is very much a red hat day. Little twinkers of excitement when we get a big red day like this. I never thought I'd be one of those guys, but I do like a good red one.
Well, I think it's one of those things where me and you are old, and so the old school that, lived in the mean reversion world, we are based on multiples, that to see this world of inelastic markets based on flows, like both sides, it's, we want to see some sense of normalcy. So I think that's kind of a, what the young kids might call a boomer take, but I do feel like that is the general feeling of all my people.
Well, call me whatever you want. I like me a bit of mean reversion. I really do. I mean, ultimately, I think I've talked about this before. There are three types of trade. There's mean reversion, which is where anyone that was schooled in corporate finance sort of lives. They like using their maths. There is momentum, but let's not forget, momentum is the most successful style factor in history. Right? Be idiotic to ignore it, but it just feels a little bit grubby. And then there's carry, right? Which is really a game that you play with other people's money.
Absolutely. And I think the carry thing is like, once you start to understand the dynamics of carry and how it can go across markets, so many people think of just FX carry, right? Like borrow yen to buy Australian dollars or New Zealand dollars and earn but the truth is like, it can be in any asset class. Part of what drove oil up in the summer of 2008 was the carry trade with the backwardation. And at the end of the day, carry persists. And in persisting markets where more capital flows to successful strategies, it can explain bubble dynamics. Whereas traditional financial theory that they taught me in grad school and you and like what they teach you at banks and the modern doctrine, if you will, doesn't explain bubbles, whereas the carry framework does.
Yeah, and what also is never explained so clearly is that, and the reason why it's a trade for other people's money is that it's a short vol trade, which I'm instinctively allergic to. But here we are. Well, you're still Thursday the 13th, not Friday the 13th, but did Mike Berry call it? I mean, there were rumors floating around the Twitterverse yesterday that Mike Berry was giving back funds to his LPs, while simultaneously advertising his Palantir put position. It would be ironic if he, well, listen. Has he called it by giving back funds here? But it'd be interesting that if him running up the white flag was the point at which this was finally going to turn. So, do we think this downdraft has any legs? I think we need to start at.
Yeah, I mean, fellow Wisconsin native Jim Chanos, one of the great short sellers of all time, had to close his fund. He was at $8 billion plus in assets, and the passive 15-year bull market kind of was a tough business for that. And so him closing it down, a year or so ago, and now Barry, I don't really know. I didn't look into the details of it. I saw people saying that. But
well, it's actually one of my key pet peeves. The sort of the slavering over stale 13D filings around all of the big traders, whether it's him, whether it's Stan Druckenmiller, whatever. You know, I really wonder if there's any information value in those public filings at the end of the day. Particularly, I mean, actually, with the exception of, you know, weird value plays, right, where people just can't move rapidly in and out. Anyone of any size can't move rapidly in and out of them. But the idea of someone going, oh, look, Druckenmiller's long a ton of NVIDIA. Well, dude, that was 2.5 months ago. He's probably selling it to you right now if you're buying because of that. But yeah, no, it's an ongoing pet peeve of mine. So you got some slides ready to go over the damage, haven't you, Ben?
Let's go. Sure. Share screen. All right. Presentation.
Not the Pornhub page. Not that one.
Yeah, no, I'm trying to find it where this is. Oh, here it is. Share. Let's see and bring it up.
There we go.
View. Presentation mode? I don't know. Whatever.
Full slide.
There we go.
There you go.
So,
there you go.
So go down. Oh, this is the other one.
That's last week's. That was last week's, dude.
Hang on, let me pull up. Sorry about that. So I'm gonna take that off. That's 1 second while I pull that up.
That was Monday's.
Microsoft basically. Speaking of Microsoft, did you see the headline that they cut CoreWeave out today?
No.
They canceled a data center with them. I didn't look into it enough.
It's not the first time we've had one of those kind of headlines, actually. I mean, I remember it the last time we had one of those. I mean, this is a bad day for one of those headlines to come out, but to be honest, it's not a. I think you got the right one there now. You can share that one.
I think we're good now.
There we go.
All right.
Black Thursday for hype stonks.
Thought it was an appropriate name. I mean,
yeah.
Hype stonks had a tough day. You know, this was the market map. It was interesting because, you know, I'm long the defensives, and XLV at one point was almost up 1%, gave it back over the day, and staples were good. Apple, you know, I would say this. I think more and more Apple is just a staple. You know, them not jumping into the CapEx bonanza that this thing is, and the way it's traded like a rock for the last month since this thing started on October 8th, 9th.
I just get bothered by the defensive nature. If you're owning staples for their defensive characteristics, what on earth is defensive by around any of those multiples, whether it's a Coca-Cola, whether it's a Costco, whether it's an Apple? You know, are these really going to work out being great places to hide? I guess the argument is that you've kind of got to be somewhere.
I think so, right? And so I guess the point is like if I'm back at Fidelity in the early days, or I'm at T. Rowe, or I'm at Capital, I got to own something because there's only so much you can have in your cash. So you move to what's stable cash flows, right? Healthcare, staples. I think Apple you can consider a staple, even though it's, you know, tech, things like that aren't taking on incremental risk of their balance sheet. So read all the hyperscalers, which should be safe credits, but they're making an internal decision to go after this. So they're risking they're increasing the fragility of their businesses, right?
Yeah, absolutely. And you know, they're undermining the very reason that people own them in the first place, right? You know, asset light cash machines, right? No longer asset light. Redeploying cash in a way that can't be used to reduce share counts, which has been a big driver of returns over the last decade. And so, you know, yeah, anti-fragile becomes fragile. And listen, I think you hang out there at your peril.
Yeah, it was interesting, because we talked about on the
one thing I would like to comment on is that the energy names have really added themselves into this defensive bucket recently. And if you just look at the way in which energy equities have performed versus really quite weak year-to-date energy prices, at least at the front of the curve, I think the market's trying to tell us something there, right?
Well, to be fair, nat gas prices are at the 52-week high, right? So you got to remember nat gas.
Yeah, but
I think
that's largely weather. That's largely weather at the moment, right? You guys are getting pretty cold over there. Probably not in LA, but your northeastern buddies are.
it's a little
Not to
that, but it's a
mention
little.
falling iguanas in Florida. It's always a good one. I love it. We love it when the iguanas are falling. It's great for the natty bulls.
But no, but I think it's also a function of the combine cycles or power plants having to probably be what people take as things to drive this LLM bull market or this LLM CapEx.
I wrote about this a few weeks ago. I mean, ultimately, we've got two things going on that make this winter independent of any weather event. We got two things going on this year, which makes winter look very different to how it's looked before. So if you look at storage balances, I don't think they mean what they used to mean. You have got so much more demand on the gas infrastructure, on the power infrastructure from this expanded population of data centers, and you've also got significantly expanded LNG export. And it's not just LNG, it's pipe gas down to your neighbors down south in Mexico. And so I don't think looking at 5-year averages in terms of sort of storage balances is going to help you out as much as people think. I think that there's a real right tail risk to gas prices, particularly if there's any kind of freeze in over January, February. So, listen, I've got a small position there at the moment. I'm kind of hoping that the weather backs off a bit to allow me to be a bit bigger. But it's definitely an interesting dynamic.
Well,
so look, I can't really.
Nat gas is up almost 100% year over year, right? So, I think there's for people who have been in the energy space for a while, we've been talking about the 2025 to 2027 trains, LNG trains that will be coming online, both in the U.S. and in Qatar, or Qatar, or whatever you want to call it, and that's a new source of demand. And now you layer on this LLM part of it and these power names. I just think it makes sense. And then you naturally in the power business, it's a long vol strategy, right? So 5 to 7 days of the year make up most of your returns, more or less. And there's more capacity payments now than there used to be. But without getting too much into a power conversation, point is, nat gas done well. Oil had a rough day yesterday. It's hanging in there. They decided they're going to sell some of, basically support some of the SPR. They'll buy some for the SPR. So maybe their idea of where the floor is around here. But I think ultimately the reason why it's defensive is the same reason as always. It's like energy is basically primary money, and it has a negative correlation to the rest of the market. So when the price of energy goes up, claims on energy, which is stocks and, move on out, like basically decline in value. And so go back to 22, you had a market where most of the entire equity market was down, but energy was strong, right? So there is a negative embedded correlation in owning energy equities that I don't know is fully appreciated. So their free cash flow yields are decent. The energy prices, well, at least oil prices aren't very good, but nat gas is pretty good. And you get that negative embedded correlation, which, has value to as a guy who runs a convex strategy where we have, we have a license to burn money, more or less. is it adds value to your overall portfolio. That's the way I would think about it.
Okay, so you got this factor map up here right now. I mean, all I can see is red. I can't read it super clear.
Yeah, it's. I
look at
should
the
have done
report.
it. Let me see if I can put it up on Bloomberg real quick. And this might. Yeah, here, I'll do that. Stop sharing, and I'll do it like this so guys can see a little better. We'll share this one. We're getting better at the sharing and all this stuff, guys. Sorry, but let's see. Share. Can't share it. It says it can't share it. Well, anyway, I'll go back to the other one. But the basic idea is that all this stuff that we saw, or you know what? Actually, we can do. Hang on, this is a better one. Here, share this. Can you see that?
No, yeah. Oh, yeah. Yeah. You want to punch it up? There you go.
Okay.
Okay.
So
you got the hyperscalers at the top there. Yeah.
So this is like a list of stocks. It's kind of like if you go back to that October 8th, 9th, whatever day it was, when we had a 4% down QQQ, and then the whole crypto space got delevered. I was like, oh, this is going to cause a lot of problems because this destroyed a lot of equity capital. And there's a lot of leverage players who are over their skis. And since then, things haven't been right. Like the deleveraging probably started in September, First Brands and all that stuff. And the private equity guys and the BDCs weren't trading well. Jeffries started to join. Like it's slowly added guys. But, when we look at this, almost $1 trillion of cap gone today. But really since the 28th, which was the day I tweeted out that we had the largest or the worst breadth for an up day in like 35 years, we're down $1.5 trillion, 6%. So that kind of comes back to this idea that the top of the market was driving things, and under the hood we were seeing it. And then I'm pretty sure everybody saw like Hindenburg omens and all these things that are breadth based, that like, hey, the market is deleveraging. And the top is usually the last to realize it. Because you remember in 22, Evergrande went out in Q2.
Well, I mean, listen, all you have to do is look at ARK versus the Qs over that time period, right? Kathy took a dirt nap, at least 4 or 5 months ahead of the rest of the market following it, right?
Yeah, I guess my opinion is more like the speculative peak of 21 was February 21, when you said with ARK. Then you had Evergrande, and then you had the junior growth guys go out, but the S&P and the Qs didn't peak until December 31st of 21, right? And so there's a process to it, and so we're seeing now the speculative stuff. And it's weird because NVIDIA and some of the top of the market stuff is actually speculative now versus, in that 21, they weren't that speculative. They might have been overvalued, but like now they're starting to say, oh, well, how sustainable are these cash flows? And like, what's driving these cash flows? Like, how long can this VC funded, boom, this, NVIDIA giving guys credits or equity and the hyperscalers giving credit, like how long can this last? And I think when you look at, and let's go back to the presentation real quick. All right, here we go. And I think that's where we're kind of getting at, is we're getting closer and closer to like, look at this, right? So this is Oracle and CoreWeave CDS, which we talked about on Sunday, continues to blow out, right? And Meta has been...
Just do the colors. You've got CoreWeave in blue and Oracle in white there, just so that it's not super clear on the screen.
and the white is on the left. So Oracle's gone from, beginning of October. CoreWeave's gone from the beginning of October, like 360. Now it's at 562. And Oracle's gone from, in September when I started really getting on the short Oracle, short Meta, like that the market, like this was about to train, gone from, I don't know, 40 to 45 to now 88. And again, like for people who don't trade credit, like these are big moves.
Yeah.
Right? Can you hear me?
Yeah, no, I can hear you loud and clear. And
Okay.
listen, we covered quite a lot of this on Monday, so on Sunday rather. But I this is not showing any signs of letting up to me.
Yeah, and so here was the other thing that was interesting. My buddy David Levinson loves this chart, and I kind of color coded it. And it's interesting, like if you take the NASDAQ vol over the S&P vol, and I have a much more detailed spreadsheet, which if we're having trouble with the details here, we're going to have trouble with that. Maybe we'll have to give up on the PowerPoint and just do the charts in the future.
Mm-hmm.
But the idea is that this is at the danger zone, right? This is when you see.
Why don't you back up 3 seconds and just explain exactly what the lines all are, right? Because people can't read the legends here.
Is that right? Well, the idea basically, and I'll tweet this out so people can see it, but the idea is that you go back to the summer 23, you go back to right before, Rupert came on my old podcast towards the end of June 24, and we were talking about the dramatic asymmetry in the market. There was very clearly a ton of leverage built up. And that was when I decided, like, I was in the process of starting this, kind of long vol convexity fund. And you can see in that chart the difference between the NASDAQ divided by S&P, which is the black line. And then this is NASDAQ vol divided by S&P vol. So there's a huge gap. And then what did we get in July into August of 24? We got a huge carry unwind, right?
Yeah.
And then now we're kind of having the same thing where NASDAQ, you can see that black line, the NASDAQ divided by S&P is starting to come down, and we're still in the danger zone of the NASDAQ vol divided by S&P vol. And so if you look when these things usually bottom, the green line right there, that's Liberation Monday. And then the other green line that's up there, that's August 5th of 24, the day that night the Nikkei was down 10%, right? So that's what a liquidation looks like. That's what a bottom looks like. You look at this chart, and that's what you'll see. And even like if you go back in this to the fall of 23, that other green line is when, rates were at 5%, and it was kind of ugly before, Yellen saved the market with the bill funding and all that stuff in November of 23.
I mean, to put this into words of one syllable, right? We are looking for another green bubble. We just don't know when it's going to come, right?
That would be when you want to buy. That would be like a bottom.
Exactly. So my point is, you do not want to be dip buying here, is what we're saying, right? To start
That's
from,
more or less what I'm saying. Yes.
Yeah.
Yes.
Exactly. So I think we started this was, at what point do we think it's over? And we need the blue line a lot higher.
Well, look also on the bottom is the put skew, right?
Yeah.
And so you're seeing those green lines correspond with huge spikes in put skew, right? So right there is August, and then right there is Liberation Monday, and here's where we are now. This is not what something
so complacent, right? So complacent,
right? So the vol market's kind of telling you that, and then the credit market's kind of telling you this. And now,
the credit market,
when we go back,
market's sounding more alarms, right? I mean, obviously, at the index level, it still looks pretty chill, but at the individual name level,
here's the high yield. Here's the high yield. We use this. I don't know if we use this chart on Sunday, but I'm just coming back to this. Is this week I had, I'm not going to get into too much privately, but I was brought to the idea of if me and you ran the foundation for your university, and we had gotten suckered into this idea of private credit, private equity, which a lot of people did, right? And now we're sitting on a giant portfolio of things where we're nervous about it. The forward-thinking guys, the David Swensons at Yale and Harvard and some of these people got out at 10, 12% discounts a year ago. Well, after the spring,
David,
go back
his successors did, yes. Yeah. I mean, I think this point, sorry, the chart's mistitled, but what you've got is the owl equity.
Sorry.
What you've got is the blue owl equity diverging significantly with high yield spreads. Is that high yield or IG? I can't see from the chart.
High yield.
It's high yield. So, as they say, two men think they're Jesus, one of them must be wrong. I mean, I'd be more inclined to back the direction of the blue owl equity right now, because of reasons I've talked about before, which is that there are just too few bonds out there to allow price discovery really in high yield at the index level. But we're certainly seeing price discovery at the single name level with those CoreWeave and Oracle CDSs that you showed.
But it's starting to pick up.
Yeah, absolutely.
And so that's why IG, has gone from 49 basis points to 54. I don't know exactly where it closed at today because I have this screen up, but I think it's 54. And I think if IG clears 55, 56 and high yield, I think the high yield CDS closed at 336. If that gets through 350, then you're kind of game on, basically. So we're getting close. Yeah. And I think that you look at a lot of the equity markets and you can see the same kind of thing where we're approaching the neckline. We're talking about some of these, terrible equities. And here's Bitcoin, right? This is another neckline. Bitcoin broke 100K. More convincing, second time it broke 100K since it surpassed it, or third, I guess, if we look at this move back in the summer. But if this thing starts to clear that, it just corroborates this idea that liquidity decay is taking over. So we're in a deleveraging period. And so everything that was run or driven by leverage, so iron, Bitcoin, your meme stock of choice, your Bloom Energy, your, whatever, these things that are way divergent from their cash flows are getting absolutely ran over at the same time where stable cash flows, whether it's Apple or XLV or the staples or my Budweiser, they're fine.
Or emerging markets. I think, anywhere where you've got a sort of short duration, low valuation, high dividend yield factor is looking like where you want to be right now.
Yeah, I think
and one of the things, if you ping it to the next slide, Ben, I had a look at the if we've got the next, oh god, this is kind of hard to read, but this was I've had a lot of my readers, I bailed out of my precious metal lines. You can see all those vertical dotted lines there. I bailed out of my precious metal miners. You just made it worse, bud.
I did. Oops.
Yeah, you're gone. There you go. Yeah, there you go. No, it's worse. It's somehow gone into it's gone into narrow mode. Doesn't matter. I mean, listen, I can do this without the slide, but I mean, essentially, I've been.
Back. There you go. Sorry.
I've got you trying to bring it up?
I'm bringing it up now. Sorry about that. Keep talking while I'm.
Yeah, I mean, listen, I've had a lot of questions because I bailed on my precious metal miners, it's now 2 or 3 weeks ago. And I've had a lot of people saying, at what point would you think about buying them back? They're certainly above the level where I sold them. And I think I need these guys, and I'm hedged in my gold anyway out until the new year. But I really need all of these miners stocks back in that sort of channel, about sort of 5 to 8% above where we are now. I'm really happy miss on that initial move because, you know, we just need the money following it, right? And if we're in this deleveraging mode, being a hero to try and buy back these miners here just doesn't feel right.
So I thought about this on Sunday, and I was talking to my partner about hey, look at gold. It seems like it's ready to take a rally, right? And then we went up $200, and GDX went from 74 to 79 or something. I think right now is very dangerous. I think right now is if we don't make a new high, and if you think about you look at a lot of charts like the Qs and the SPYs, we had this. So here's the way I think about it, right? People were complacent. Government was shut down. They're like, hey, when the government rallies or reopens. And on Friday, I had covered a lot of bubble shorts and some very speculative short-term puts. Friday around 11 o'clock, 12 o'clock, right? Close to the lows. And then Monday, we get a rally into the end of the day, and we get a rally Monday because I thought the flights for Thanksgiving would force the government's hand, which it seems that it did.
Good call. Good call. It looks like it did.
But that government open rally did not last very long. And I was very surprised by how weak the Monday was, even though they're like, oh, tech's up 2%. It just, the whole Monday, Tuesday complex felt very much like a short covering thing. I guess technically I was a buyer, right? And so there was a lot of guys like that. And then I think what happened is that people realized, oh, the data is going to start coming in. And the ADP wasn't very good when it came in on Tuesday or Wednesday. And I think that got people thinking oh, now we're going to have to see the rest of this job data. Then this dumbass administration was like, well, we're not going to give you the CPI or the jobs data. And it's
apparently we're getting our inflation data from DoorDash now. Did you see that, Jem? Apparently we're getting our inflation data from DoorDash.
So that requires a derating by itself. Just the idea you're not going to give data out, and there's the coincidence that all the Doge firings, their severance ended on September 30th, so those would show up as a negative. So it's not this administration not necessarily the brightest bunch. Of course, they want to hide that, and so basically you get this situation where then I think you look at that NASDAQ versus SPX and vol and in the ratio, and we have this buildup. And today the market was like, we're out of here. CoreWeave wasn't very good on Monday. And I just think that when you look at the credit markets, the equity markets, it's just starting. It's just hard to put your head in the sand and do the ostrich move right now.
Makes perfect sense to me. What am I thinking about right now? I mean, I got one more slide. As I said, this is a relative chart of Indonesia versus EM, right? Going back to going back a couple of years now. If you look at longer dated charts of EM versus SPY, and you look at the daily chart of this Indonesia one, I think that there are a few really interesting low valuation catch-up trades that are exciting me in EM. I mean, I really stretched people's boundaries last weekend talking about frontier markets with Uzbekistan, but Indonesia is much more mainstream, and this is where I've been spending some time this week, and I'm going to write about it this weekend. But I think keep an eye on this one. Indonesia is a classic beneficiary of a multipolar world. They have a chokehold on the Straits of Malacca, and the fourth largest population, strategic non-alignment with both sides, and the Saudi Arabia of nickel. I'll be feeding into all of those themes in my weekend note.
I mean, Indonesia, that currency has not necessarily been a safe haven. Let's put it that way.
Yeah, but listen, it's now got it's doing EM central banking 101. You've got proper real rates there. Actually, the currency has been remarkably stable given some of the political headaches over the course of the last 6 months. We've got to sort of the tail end of the first innings of the Jacobi-Prabowo transition. I think as an EM for 2026, it could definitely be one to watch.
I'm just saying that.
Yeah, no, listen, there are plenty of serial devaluers in emerging markets. Just look at India. I think that's a better chart than India.
Oh yeah, and by the way, it's a very similar ticker as well. Instead of IDR, we just have to do INR, and I would say you're right. Look at that. Looks like it's going to explode. Remember I was pitching you on Indian FX vol last summer?
I thought I was pitching you. I get confused.
No, it's one of those. I mean, I don't know who's taking the other side, to be fair. Like,
listen, for me, I mean, I'm really not bearish emerging markets anywhere right now. But for choice, if I have to pick a funder in emerging markets, it's always going to be India.
I mean, look, let's go back even farther. Let's go back to like 2000. What do you want to do?
You go back 20 years, right? This thing's done nothing but
go back to 2000. Yeah, there you go. since things blew up in August of 2007, like the beginning of the GFC, you've gone from a 40 to an 88.
Currency's more than halved. The currency is more than half versus the dollar. Yeah.
To be fair,
cool.
Indian equities have been okay.
Yeah, and they're nosebleed expensive. Right. This is why I'm not in that leg of the trade right now. But as soon as India shows any kind of technical weakness, that's the way I fund the rest of my EM longs.
Yeah, I mean, I guess it's interesting because this year, clearly, when you dollar adjust the S&P, the returns are meh, right? Like, and so maybe it's the beginning of that same unwind in the .com where you had strong dollar, strong S&P, and then you buy. I think that DXY peaked in 2001. Let's see. Let's go back since I have the long term. I don't even need to ask.
Yeah, all you got to do is change the letters. Yeah, there you go.
Go to 1998. And so the dollar actually peaked in and this is kind of what I think is going to happen again, to be honest, is that I think we have one last little dollar rally on our hands. And if you look, this was the dollar selling in 98, and then we had a rally, and it was kind of chopped around. And 98 is the only time that I could see that was like what we saw this year, where bonds, dollar, stocks had a similar dynamic. What?
The Yazoo.
Well,
yeah, I'm on the other side on this one. I've looked at the dollar throughout the course of this summer, and it's been threatening to put in one of those face rippers, and every time it kind of quietly goes back to its kennel with a whimper. So I'm just not seeing necessarily what triggers the that sort of that rollback in the dollar. Could be wrong. I'm certainly because my positioning is very much has a short dollar bias generally across my portfolio. I own hedges against that happening, but they're looking increasingly like sort of a waste of premium.
I mean, here, I'll show you exactly. Like, this is the actual trade weighted. Looks, much better. And so when you look at the DXY, which is what most people think about when they think of the dollar index, it's massively overweighted to the euro. Let me tell you something. There's no currency I'd rather be short in the world more than the euro. All in short euro. Like can't tell you the peg that is that currency of how much I dislike the euro. But Rupert and I, we're partners and we're buddies. We have a little bit different view. But if the ECB decides, hey, we're going to stop lying, we're going to start cutting rates, because you know what? Now the Swiss franc is appreciating again, and they're getting inundated with cheap exports from China. And UK is not in great shape. They might have to take rates lower. And then I think that would be what would get you that next leg lower in the euro, and maybe some deleveraging globally in assets where you get that not a sustainable strength in the dollar, but kind of like how the end of 2008, you had a ripper in the dollar, because in deleveraging moments you could get a ripper, and that's kind of more of what my thinking is.
Yeah, I'm not seeing it, but I've got insurance against it, right? You have to insure against something like that happening, but I'm just not seeing the catalysts right now. And if you look at sterling in particular, right, there could not be a worst barrage of negative headlines on sterling right now. But you know what? Price doesn't care at the moment.
Yeah, I mean, let's look at this real quick. Where
Okay, this is the last slide, Benny, because we're at the 40-minute mark.
Last slide will go. Let's look at this one. This is the skew. So, like, what's driven the euro in many ways for this year? I don't know why this is so slow. Is here. This is basically it's hedging. So the green is the euro dollar or euro US dollar put skew versus the actual spot rate, and you can see it trades along the same line. So huge hedge demand, huge hedge demand. Look at this. This was when the dollar was peaking right there in the beginning, right around my birthday in January. And then like that. And then it kind of is abated. And we got excited there, and now it's kind of come back a little bit. And there's
that was the dog whimper I was talking about.
Yeah, no, agreed. But like if we go back to just this normalized level in here, it's going to go weaker. If the ECB starts to cut, it's going to go weaker. So anyway, we don't have to agree in everything.
It's beautiful that we don't, my friend.
We also don't agree on the dollar and the RMB. We have a internal bet over a nice case of wine of what is the first strike. So maybe FX is just the ultimate.
I just spent a bunch of time with Louis Gave, so I'm feeling really, really punchy about that bet right now.
Well,
listen, let's say goodbye to everyone. Let's say goodbye to everyone. We will see you all again on Sunday night. Thanks very much for joining. You can find Ben Capital Misallocation on the Bird app. I'm at blindsquirrelmacro.com.
Either one.
Yeah. See you Sunday. Cheers,
guys. See you Sunday, guys.